Very good evening, gentlemen. Today's topic is TDS on redemption and other type of TDS that is generally deducted from our incomes, along with tax collected at source, that is TCS, ITRU, that is a new feature which has been enabled from this year onwards, and assessment year and financial year. The first question that arises is deduction of TDS and collection of TCS. Now, TDS is deducted and TCS is collected. So, TDS, as we say, so that tax deducted at source. TDS is made in compliance with the income tax provisions at applicable rates. This is done from the deductor side. These rates are different for residents and non-residents. So, the rate that is set for the resident is different, and for non-resident it is different. Now there can be various kind of TDS. Now TDS on salaries, rent, commission, interest, dividend, contractual income, professional income, sale of property, etc. Additionally, non-residents attract TDS on redemption of securities as well. So this is one question that will be attended to, that TDS that is ordinarily made on redemption of securities, do we get it back? And if yes, how? The other portion is TCS, that is tax collection at source. This is paid additionally on certain items, the most common being while buying a car. So when you are buying a car, the TCS is paid in addition to the cost of the vehicle. Now, a question arises whether TDS or TCS, by whatever name called and under whatever section, is it recoverable or not? Now, this is exactly the answer we're trying to seek to. It doesn't make a difference for us whether it is TDS under section A, section B, or section C. The answer is yes. TDS on redemption or any other nature of receipt. Any other nature of receipt. So whether it is rent, it is your interest, it is your redemption, anything. And TCS paid during the financial year, it is as good as tax paid to the government. So whatever is being deducted from your income and that is being deposited by the deductor to the credit of the government, it is as good as tax paid to the paid by you, provided you are furnishing your PAN number to him. So if there is no PAN, there is no linking, you will not get the credit of that tax. No government shall deprive any person of the rightful tax paid by him, including tax deducted or tax paid by him as TCS, in excess of the tax payable. So it becomes important to say that first of all, you have to also calculate the tax payable. So you cannot directly say that whatsoever is deducted shall be refunded to you. First of all, you need to know what is the tax payable for that year. Accordingly, credit will be given for the taxes deducted. The balance, if any, shall be refunded. The deficit, if any, will have to be paid to the government. Whether the same will be refunded back depends upon the computation of income of the total taxable income for the relevant year along with certain conditions. So there are certain conditions that need to be fulfilled, right? Without fulfilling these conditions, credit for taxes or refund of those taxes will not be provided. So here comes condition one. Income tax return to be filed for the relevant year. So this is condition number one, that first of all, you need to file your return of income. Now, The return of income is to be filed by the due date without late fee, right? So there is a due date for filing of the returns. If you file your returns by the due date, there will be no late fee. But if you are filing a return after the due date, it shall be called as a belated return, right? And late fees shall be applicable. So, return is to be filed by the due date without late fees, and belated return with late fees by the last date to file the ITR for the relevant period. So, when we say the last date to file the ITR, it obviously means that there should be a date by which the government expects us to file our returns, right? Then, the due date of filing for a financial year is 31st July of the succeeding year, right? Now, this is as per law. This date may or may not be extended, that depends upon a lot of circumstances, but ordinarily speaking, the due date of a financial year is 31st of July. So, for example, financial year 2021-22, that is year ending March 2022, the due date to file the income tax return was 31st of July 2022, right? After this thing, this line is very important. Let me just, highlight this line. The last date to file the ITR is 31st December of the succeeding year. After this date, no ITR can be filed in the ordinary course of filing. Two important words: ordinary course of filing. So for financial year 21-22, the last date to file your return with late fees was 31st of December 2022. This is in the ordinary course of filing. So let us also see, is there any extraordinary course of filing? That is the question. To exemplify the same, for financial year 2021-22, the due date was 31st of July 2022, and the last date was 31st December 2022. Correct? Condition number 3, all incomes have been correctly and appropriately reflected. Now, there are two things to it. It has been correctly depicted and it has been appropriately. Now, when I say correctly would mean that the right kind of amount has been shown in the ITR form. When I say appropriately would mean reflecting those correct figures under the correct heads. It would be actually incorrect to write the income in a different head of income. So if there is a capital gain, it should be mentioned under capital gain. It should not go to either your salaries income or to your rental income or to other sources income. Right? Then, another important thing to be kept in mind, if the tax payable for the computation of a particular year is more than 10,000 rupees, then the provisions of advance tax shall be applicable and interest shall also become payable. Right? So for those people who have incomes in India, either by way of being a non-resident or even if they are not fulfilling the days and filing the return as residents, they should take care of this matter and appropriately they should deposit the advance tax. Then another important part, the government has enabled filing of 2 financial years preceding the financial year by way of ITRU. The ITRU can be filed within 2 years from the end of the relevant assessment year. Correct? For filing of the ITR, if the ITR has not been filed, or if the ITR had been filed, that revision of that ITR. So under ITRU, there are two cases that are covered. One, if the ITR has not been filed. That is part one. Second, if you have already filed a return, but you think that there is some incorrect versions to that, then you can also revise your return. However, conditional conditions for ITRU. So even ITRU is conditional. What are the conditions? The first condition being you cannot file ITRU for a return of loss. It means the government expects that you contribute something to it. So any return of a loss that is not going to be accepted in ITRU form. Second, it cannot have the effect of reducing the tax liability if ITR was filed earlier. So let us suppose that an individual filed a return on which the nominal tax was, let us say, 20,000 rupees that he paid. Then later on, he thinks that there is some error and he wants to rectify that error and he wants to file that ITRU form. It is not going to be accepted because if he thinks the liability is going to come to less than 15, up to 15,000, which is less than the original 20,000 rupees, then ITRU is not going to accept it. But if the overall calculation has the effect that instead of 20,000 that was made originally, it will be enhanced to 25,000. Yes, the ITR form is going to be accepted. So in cases of if ITR was filed earlier, let us write it as if the original amount of tax was 20,000 rupees. Under revision, if the overall tax comes out to 15,000 rupees, ITRU is not going to accept it. But if it has the effect of enhancing the original tax, let us say it becomes 25,000 rupees. Yes, it is going to accept it. Now, most importantly, for those people who have been asking this question that we want to file the return for the previous years, yes, since some income can be made to it, even if you're filing zero return income for the first time, you will have to pay the late fees, and yes, you can file your returns. But if there is any TDS that has been deducted, there can be no refund under the ITU form, right? So if filing for the first time, ITRU, filing for financial year, let us say 2021-22, no return was originally filed. No ITR filed originally. Then even if he wants to file a return declaring his income as 0.00, he will have to pay a late fee and return can be filed. Along with the late fees, if there is any Indian income, then tax proportions may change. But if there is like a zero income, which may include any income which is exempted if he fulfills the NRI criteria, even that can be shown. This form shall not be applicable in cases of search and survey, and this form cannot be revised. So once you file ITRU, it is just a one-time opportunity for a one financial year. To avoid hardships, it is always advisable to file the tax returns. So this is the net solution to all the hardships related to claiming overdue tax amounts. If there is a tax, kindly check whether there is a tax that is deducted. Try to claim that tax. Otherwise, once the financial year gets over and the limitation period for which the return can be filed gets over, you actually cannot get that money back. Then, there is another important thing. Tax deducted of non-residents under Section 195 should be reclassified under the respective head of source of income. Now, why I say this? Earlier, I just mentioned that there is a difference when I say correctly and appropriately. This is exactly what we mean by the furtherance of this subject. For example, TDS on redemption of a mutual fund in 26 AS shows the amount as rupees 1 lakh rupees with a TDS against it of 10,400. Now, this amount has to be shown under the head capital gain with proper depiction of sale amount and the cost of purchase. So under the capital gain, you should respectively show these figures, sale amount, and then under the column of the cost of purchases, you should mention the cost that was made for the purchase of that asset. Then, another important part, financial year versus the assessment year. Now, these terms, though they are used interchangeably to refer to the same time period zone, but they are depicted differently. The income tax department generally uses the term AY, that is assessment year. Therefore, you shall see assessment year in most income tax forms. Now, let us exemplify this thing. The period 1st April 2021 to 31st March 2022 is referred to as financial year 21-22. Now, this is something which is common and easily known to everybody. Now, this time period, that is same time period, 1st April 2021 to 31st March 22, is referred to as assessment year 22-23. So if you see, match the time period, 1st April 2021 to 31st March 23, if referred as a financial year, becomes financial year 2021-22. If referred to as assessment year, it becomes assessment year 2022-23. In short, what we can say is assessment year is 1 year after the financial year, but referring to the financial year. So, for example, assessment year 2023-24 is financial year 2022-23. That is 1 year difference is mentioned between assessment and financial. The logic being that once the financial year ends, we can do an assessment only after the financial year gets over. So the income tax department analyzes the returns in the next year. So therefore, they call that period as the assessment year, referring to the same financial year. One more important element which many people actually do not claim. Claim interest on housing loans even if there are no taxable incomes. This is going to go a long way in helping you out in future for maybe your taxable incomes, right? But for those people who are having housing loans and paying them accordingly, the interest certificate from the bank or the financial institution is divided into two parts. One part is the interest element, and the other part is the principal element. You will get the benefit of interest paid on housing loans under the head income from house properties. Please do claim even if your income is not taxable. And as we come to the closure of this particular chapter, it is very important. The way to get ahead is to get started now. Now, for those who have not been able to file their returns, start filing at the earliest note. Register your PAN on the income tax website. Create the user ID and password. Log into the income tax portal. Check for a communication from the department on the website, because these days the information is e-dispatched. So earlier what used to happen was the manual postal, communication used to be made. Now, in majority of cases, all communication is done via e-mode. After logging on to the income tax portal, check for three golden ratans: 26AS, TIS, AIS. The government has basically made these three things for the taxpayers' use. Use them, analyze them. They reflect almost all the transactions that are being made, right? And captured onto different reporting portals. Also, after you have done that, check for communication on the reporting portal. Now, reporting portal has a link which is enabled in the income tax portal itself. Now, 26AS will depict your TDS and TCS. If there is any TDS that is made by a deductor but not currently reflecting in your 26AS, the department is not going to give you credit for that, right? Similarly, if there is any amount which is mentioned in your 26AS which you feel does not pertain to you, you should try to find a solution by reporting that thing to the deductor to revise this particular TDS returns. The second is TIS. Very helpful, very helpful. TIS will tell you the transaction information summary of all transactions done and captured by the reporting entities onto the tax portals. So these are three, and AIS is annual information summary, which is clubbed with the TIS. TS and AIS, they go hand in hand. So please go through 26AS, TIS, and AIS. They will help you a lot in creating and making your tax proposals and calculations simple and easy. Thank you.